We're getting into, it's just interesting that we've used the word Trump today, but all right. We're getting into a conversation about what to play this year, 2025. And our good friends from Standard Chartered are here. We'll let you know just about that in just a minute. And even as we do, let's just say a good morning and a great Situation Room welcome to both of our guests this morning. Paul Njoki is the head of Affluent Banking and Wealth Management Products, Kenya and East Africa. Paul, good morning. Good to have you here this morning.
Good morning, Du.
How are you?
I'm great.
Happy New Year.
Happy New Year.
Yeah.
Good to see you again.
Same here. And also we're joined for the first time this year by Manpreet Gill, who's the Chief Investment Officer, Africa, Middle East and Europe, Standard Chartered. Good morning to you.
Good morning, Du. Thanks so much for having me.
Thank you for being here. And off the jump today, we're looking into what cards to play, playing your Trump card, investing in 2025. Okay, but before we do that, as we normally do, let's welcome you with today's proverb. You tell us what you think about it and, how you would interpret that and what you think about that. That's what we do. First time in the morning, we give you a job to do. We give you something to do as we get into it. And CT, you may not know this, but CT has this wonderful ability to go to a different African country every week. Don't ask the how, just know that it happens. And then he comes back from these countries with a basket of proverbs from a particular country for the week. And so today he'll share that with you, and then you let us know what you think.
This country has some fairly unique features. It is one of the cleanest countries on earth, not in Africa, on earth. It is the second most densely populated country in Africa. And it has the best gender parity parliament on the continent.
Mm-hmm. Do you want them to guess, CT?
I see them nodding.
Okay.
So I'm assuming they've understood that I expect them to respond. Which country do you think this is?
Well, if I had to hazard a guess, I'd say it's Rwanda.
Good hazard?
Yeah, it's Rwanda.
You'd hazard Rwanda as well. Yeah. You clearly spent your time well in geography classes. It is Rwanda. Yes. It's actually a very interesting country in many, many, many ways. The proverb: the most extensive land is the human belly. What do you think this proverb means, and how would you relate it to real life?
The most extensive belly is a human. The most extensive?
Land.
Yeah, land is the human belly.
Yes.
Yeah, you keep planting every day and just never get full.
Wow, yeah.
Well, if I think about it another way, extensive land, right? It's a great example of you can do with it what you want, but how you discipline yourself is also important. You can cultivate it badly, not have control over your belly, or you can impose a lot of discipline. And I think there are many parts of life where whether your diet, your exercise, or indeed your investment life, you really can, you can lead to a good outcome or a bad outcome depending on your own discipline.
Mm-hmm. Very true, because everything we're going to discuss today revolves around what you just said. The ability to manage the resources you have well, and that comes about when you have the requisite discipline. Yes.
Indeed. So, Manpreet and Paul, even as we get into this conversation, we're talking about wealth management and we're talking about investing. And that's one of the ways, from the conversations that we've had with you over the last 6 weeks, and then getting into the new year, is really looking into how you can, create and manage wealth. And one of those that we've been able to hear and really get into has been investment. And I guess that's now forms the conversation that we'll be having today. You've been in the business of this wealth creation and management for over 2 decades. And, being able to hone in on that specifically and say, you know what, guys, this is what we can actually do. This way you can actually put your money. Let's get into this by just doing an overview of, all right, wealth management in the last 20 years, in the last 25 years. What have we actually been able to achieve, Paul, and what are we looking for going into the future?
Thank you. I think when I look back, it's with a lot of nostalgia because, I remember back in the day when you started, you gotta have have a view of where you would want to be. But looking back, you've surpassed that view multiple times, and it's because of the support that we've gotten from Kenyans, particularly, the individual investors and the small businesses, because that's a focus of our business from an investment perspective. But some of the numbers that I do remember, 2016, we were just about 19 billion of asset management. Sometimes this year we closed 200 billion. So you can actually already see there's a clear, 10 times multiple of that number. And I'm sure when we publish the number for end of year last year, it will be slightly more than 200 billion. And we look forward, right?
These figures we speak of, do they represent only this country? Do they represent the region? Do they represent the continent?
Kenya only.
Only Kenya?
I'm talking Kenya only, yeah.
That is a heck of a lot of money.
Yeah. It's Kenya only, yeah. But also I also look at the sophistication. We started with, very simple products. They were far and in between. But now we've completed the range. If you're looking for a simple investment, the SC shilling with 500 shillings, right?
Yes.
And also you're looking at more of the complicated, more sophisticated products, like structured products. We got the range, and also the currencies from shillings to pound to euro to the dollar, and we can do that. And of course, some of the conversation we'll be having today, you'll see how much scope we can actually bring into the Kenya market.
Sure. And even Manpreet, as you talk about that, we talk about investments, we think profits. Okay, I'm going to put in 500 shillings. At the end of the time, I want 600. I've made a profit of 100 shillings. But haven't we seen a diversification of that to make sure now that the folks who now brought about 19 billion in 2016 and are bringing about 200 billion in 2024, that you're actually seeing an achievement of life goals and not just, putting in the 500 and getting 600.
No, absolutely. And I think the fact that obviously, wealth creators have achieved success at various points in their life, which is why they're able to deploy this. But, that process, that discipline of achieving diversification, achieving a positive return, that never goes away. And one of the simplest reasons why we still need to maintain that discipline and make sure we make good use of our resources is that you have inflation. That's the one thing that continues to eat away no matter what sort of shilling or dollar value you start with. And that's before you want to think about earning a positive return. And that's why, look, we can talk about, the range of products and asset classes you can invest in. But the single most important thing, whether you're starting with 500 shillings or 500 million, is to really step back and say, look, what's the purpose? What am I trying to achieve with this investment? Is it just a little profit? Am I trying to beat inflation? Am I trying to take a little bit of risk to generate a much higher return? And spending time defining that and then really building your investment strategy around it. And that discipline doesn't change. It applies to the smallest of figures, it applies to the biggest of figures. But it comes back to the proverb we started it. It's about what you do with it and what discipline and plan you bring to that.
For a very long time, investments have been, for majority pretty much, has been, I want to get this money, cash in, get out. But here we're talking about investing for a certain goal, and this then goes into place in having discussions with the would-be clients and making sure that they understand the reasoning behind investing for a certain goal. Goes into communication with the client. So how is the uptake in terms of just changing the mindset?
Yeah, and that's a very, very good question, because when you think about wealth management, it starts with the state of mind, right? It's not about having the money, it's having the goal that you want to actually get wealthy. And what we've seen over time is the goals generally do not change. The life goals are generally the same. Of course, the way they are framed could be different. We all want to put our children to college, right? We are keen about having an emergency, kitty for, say health emergency or that kind of thing. We want to retire in dignity, and if we do a good job, we also want to pass some of the wealth to the next generation. So those are generally the goals, right? But we want to be able to talk about it in a way that the client understand their own life circumstances and interpret that now, right? So that's the first thing. Then the other piece is also understanding the client's own way of approaching investment. There are people who are conservative, and they'll go slowly but surely over time, like the tortoise, right? But they'll still get there. The others who want to, be a little bit aggressive, but that's okay. So understanding that becomes very important, and then bringing it together and bringing the solutions that, Manpreet and team bring us to be able to then implement those goals to actual investment that the client can benefit from. Yeah.
This entity called Standard Chartered has been around for a century plus, hasn't it not?
Yeah.
So it means that only 20 or thereabout years into this century is what we have experienced. What is it that you have as a plan for wealth creation and investment for people who will carry this institution well into this century in preparedness for the next century?
I think one cornerstone of that is always thinking long term, right? And it shows, like you said, in terms of how long we've been around and as an organization. But actually, when you think about the portfolios we create, every year we actually start with a 10-year plan to say, okay, if I had to build a portfolio, what do my returns likely to look like over the next 10 years? And based on that, what do the simple baseline, allocation look like? And once you have that in place, of course, you can talk about, okay, this year, I think, we think equities will do better, and some other years our views might be different. But what it does is force us to all think about, again, small or large figures, what's that foundation portfolio that not only gets me invested, but make sure I stay invested for that long term. And I think what we know from theory is that taking a long-term view is one really important cornerstone of generating wealth and investment returns sustainably over time. But that's exactly what we built into our process to make sure, regardless of the individuals and whoever's around, the organization, the wealth portfolios, we're always thinking long-term and not just the next trade.
You see, the portfolio I'm thinking of is a portfolio that focuses on the human person. And this human person is called youth. Because ancient crocodiles like myself are on their way out. And we will definitely not see the next century. It doesn't matter what we do, okay? It is a question that I always bring up because we do not have a saving culture in this country that you can speak of. There are those who have the discipline, and it follows perhaps the families in which, or the ecosystem, or the society, or the community in which they have grown up in. But it doesn't have to stay that way. We actually can make it a national culture. Now, if you're to venture out of your normal comfort zone of just banking and looking at investments, has Standard Chartered considered investing and looking into and partnering with educational institutions so that these principles we speak of now, when people are all grown up and have wonderful ideas about what they want to do, when those ideas can actually be grown and nurtured and matured, has Standard Chartered considered how it is that they can do this? Because in my mind, this is what would carry Standard Chartered on to the rest of this century and on to the next.
It's interesting you bring that up because, while one part of our day job is the day-to-day investing, there's a parallel series we run on investor education. And it sort of goes to exactly what you're describing, to say, look, we might spend a lot of time thinking about markets, what Trump will do, and what else might happen. But at the basics, it's about saying whether it's a new investor starting the journey, as a youth, or it's a more mature investor, how can we help along with that journey? And pieces we publish over the past years, they're almost evergreen. They're, asking questions like, how do I build an investment plan? How do I think about protecting wealth? How do I think about investing in stocks versus more diversified, assets? So these are things that, yes, of course, we can always do more, but it is almost like a parallel path we do in this investment office. Not only think about markets and investing today, the next 1 year, 5 year, 10 years, but also how do we make sure that continuously we educate investors across the spectrum about doing this, what we think is a better way.
I'm going to ask a direct question. Of the portfolios you have, do you have a figure as to what percentage of the individuals who invest with you are under the age of 40?
I can take that. I think, and bring it home, right? And SC Shilingi is a very good example, because when we roll out the product, we didn't know, but the data now has come. About 39% of all clients are below the age of 30. and then another, below the age of 30, and another about 36% are below the age of 40. So in total, you get about 77 to 78% below the age of 40. Okay? And we see that dynamic actually playing out even in the other products like the Signature CIO that we launched a year and a half ago. We are seeing the young people coming in. And one of the things that are attracting these people is that the product offering is digital. They don't want anything that you sign papers anywhere. They want everything on the phone, right? And to add into what Manpreet has said, we're also putting a communication series, which we put in podcast, investor tips as well, digitally, in the digital channel, so that the people can actually consume this information, approaching from different corners, but over time, and then you have it that. It's something that we have to keep doing so that we build the next generation of investors.
Right. So even as we look, it's still time when we're in the beginning of the year, and it's just interesting that Manpreet thought every year we do a 10-year plan, right? Coming from Standard Chartered, but so now we're saying, okay, there's a card to be played in 2025, and we're still early in the game, as it were. So what are the points that we are looking at in 2025 and saying, okay, these are the big ticket items, and we're saying, okay, I'm sure there are going to be folks who going to come to the RM and sit and say, okay, so what are we going to do this year? But even as we go into that now, what are some of the areas in which you're looking at and say this is, because that is it about wealth management and affluence, is that there are certain areas that you're going to say, this is where we think you should go into, this is where you should put your shilling. What are we looking at for this year?
So I think there are a couple of themes that come through this year. I think number one is really about how do investors get exposure to growth. There's been a big debate about whether Trump's presidency will be good or bad for the world economy. And we'll most probably see a bit of volatility, a bit more than what we saw in the last couple of years. But the bottom line is that we think that the final outcome will be a positive one for economic growth. And that means it's a positive one for asset classes exposed to that. So stocks, global stocks, we like the US a little more than the rest of the region, but stocks in most parts of the world should do well. And other growth-like assets, in the developed world, for example, we look at high-yield bonds, which are obviously a type of bonds that is more exposed to economic growth than what's happening on interest rates. So I think that's one cornerstone. But the second one, of course, is we do want to achieve a reasonable amount of diversification. We do think there'll be a little bit more volatility compared to the almost straight line up we saw in most equity markets last year. And that's why we think gold plays a key role. Because gold is almost driven by very different factors.
Gold, the shiny stuff.
The shiny metal. Right. Whether you want a physical one or an electronic version, investors like both. But what's really interesting about gold is that if I look at returns of the past 30 years, they're not that far off from what stock markets have done. But what drives it is very, very different. It's not about economic growth, but it's really about the fact that supply is limited. And in recent years, especially, we've seen central banks come back as big buyers of gold. Of course, we also like it in portfolios because if stocks and high-yield bonds have a bumpy ride, then gold can be a great stabilizer, at least in the short term. So I think that combination of assets together, and I think the third cornerstone is achieving enough diversification.
Right.
We haven't spoken about high-quality bonds. We haven't spoken about currencies or commodities, but the equities and gold might be the ones we like the most, but a well-constructed long-term portfolio, of course, will still be well-diversified across geographies, across asset classes.
Right.
Those three principles, I think, are what we're really looking at in a year when we're most probably going to get a lot of big headlines.
So I think there's a lot here, right? But if we talk about diversification, when you think about diversification, and I'm here with my 10,000 shillings, how diverse can I get? Because one of the things that we do talk about is, okay, so first of all, currencies. I can have Kenya shillings, but who says that I cannot, invest my money in other currencies, euro, the British pound, the US dollar. I can do that. But now when we talk about diversification, so how do I know where to go? How do I know where to put it? I know that's why you're there, but then what do you advise?
Yeah, and that's a very good question, and it's a question we asked ourselves about 2 years ago, and it was coming from clients saying, okay, how do I actually get into the market and achieve the diversification that the CIO office is telling us every year? And we came up with the Signature CIO funds. These are funds that we had for the longest, been having in our private banking unit, and we brought it down now to retail. We made the tickets smaller, and we made it digital, so the clients can get it on the app, and these particular funds, there are 4 of them. So there is a conservative fund, there is a balanced fund, there is an income fund, and there is a growth fund, right? So depending on the client's risk appetite or the ability to invest in terms of their risk parameters, then they can pick 1 or 2 of those. So for example, if a client picks the balance fund, immediately that balance fund reflects the views that Manpreet has just spoken about, and then they are edited every single time that the CIO office have a change of view, or they want to in terms of the forecast, then they actually automatically make that change. So as a client, you don't have to do anything.
Okay,
all right,
it's done.
Okay.
Oh.
So we look at the year 2025 as we get into it. There is the Trump now is the president, decisions that would be made, and no one knows how the market will be in the future. And with this now comes in your clients in terms of avoiding emotional decisions that would emanate depending on how the market will be. Could be volatile, could be smooth. But how then do we sit down with the clients and making sure that any decision they make is that which will help them grow their wealth even better?
Yeah. I'll take first, and then Manpreet can add. I think the really fast thing is having the conversation around the goals. I think I can't overemphasize that.
Right.
Because if you set a goal, say you're putting your child to college in the next 10 years, that's a goal. Now, the market may have volatility within that period, but that's the goal we've set. So for us is to agree, how do we execute in a portfolio so that goal is achieved? And secondly, that we are able to ride whatever volatility may be there and deal with the issues of inflation, currency depreciation, and all that. So that's the first thing. Now, the second thing is understanding the client's risk profile. So if the client is conservative, then we take a conservative route towards that goal. If it's aggressive, we take an aggressive approach to that goal, meaning the client can sleep good at night. We don't want to start a conservative client into an aggressive portfolio, because then every day they're like, oh my God, what's happening, right? Again, if a client is an aggressive investor and you make them conservative, every day they're like, man, this thing is too slow, man.
So when you say it's too slow, it's too fast, because in my mind, the picture that I created in my head is how, you have folks who are crunching the numbers and I'm watching that screen and things are going up and down. So when you talk about high risk, somebody who has an appetite for high risk is when you say, okay, I want to be able to put a lot of this money here and I want to watch it grow.
Yep.
Or when you say conservative, the one whereby it's like the tortoise. You put this money here and you are sure it is 1 shilling a day, but at least we know it is 1 shilling a day. We leave it there and we sleep.
Precisely. I think you've defined it very, very well.
Okay.
Yeah. So they and the aggressive investors, they also like a little bit of the thrill, right? And they want to more constant conversation with our RM. So where are the markets? What is the views coming from the CIO? Do I need to make adjustments, right? So that's the way the aggressive investors do. Of course, the risk and return, right? The equation generally is the higher risk you take, you get a higher return. But also the other way, high return, also high risk. It can be the other way. So the aggressive investor may get there quicker, but they have taken quite an aggressive route, right? The conservative may get there a little bit later, but then they have been easy. They haven't had to have sleepless nights at any
heart
time.
attack.
Yeah.
No, I think what I'd add is that I'd almost re-emphasize the point on goals, because whether you're a conservative or an aggressive investor, it almost helps define how to react and how not to overreact. Because a conservative investor, to your point, Paul, might be a point where you're looking to avoid sort of making mistakes through volatility and try and achieve more sort of consistency of returns, reduce the risk of sort of events surprising you, but that's also important in terms of how you define the goal. For an aggressive investor, that doesn't mean they have to become short-term in nature, but what it means when events happen, and events can happen very quickly, I think it makes it much clearer how an investor should react. So if we do get a volatility event tomorrow morning, as an aggressive investor, the big picture perspective, the long-term view can help define, okay, should I act? In some cases, the right answer might be not to do anything. And we shouldn't discount that quality, that option, that's a decision as well. So I think it still comes back to the point about defining the goals. That's perhaps the single most important thing, and not confusing sort of risk appetite with the need to do something and act quickly. I think it just provides a better guide on when to do something and, in fact, when not to do something.
Indeed. All right. We're talking about, so what card to play in 2025? Where are you going to put your money? How are you going to grow your wealth and manage that? Our very good friends from Standard Chartered are here. Manpreet Gill is a CIO, as the Chief Investment Officer, Africa, Middle East and Europe. And Paul Njoki is the Head of Affluent Banking and Wealth Management Products, Kenya and East Africa. Okay, so what do we do in 2025? Manpreet and Paul are here this morning. And as we do that, I guess that's just the question, that there may be folks who've been, part of this 200 billion in 2024, and are saying, yeah, well, we've tried it. It seems to work. But then there are folks who've done nothing, but also say, I have the goals. I want to send my children to university wherever in the next 10 years. I've never done this before. What are your first steps if somebody's at a first step status, Paul?
Yeah, so thank you, and a very good. Where do we start? So the first thing is that talk to us. You can either approach any of our branch network, or you can email us at wealth.kenya@sc.com, wealth.kenya@sc.com, and we're gonna put you close to speak to a relationship manager, and an investment advisor. So that's the first step, and that step is to help you be clear about the goals and, of course, the risk capital, as we mentioned in the previous segment, right? Once that is done, the next thing then is we showcase for you the product range that we have, from the simplest of the products to, I would say, of course, again, depending on your risk appetite, to the more sophisticated products, and then obviously then see, what is the right mix of these products to have in your portfolio. And then we get started. The execution is digital, so we're able to put the deals digitally on the mobile app very, very quickly. And then there you go. After that, then there will be regular conversation to ensure that indeed that the direction where we've set the sail is indeed the direction that you intended, and we monitor that over a period of time, and then off you go. So I think that's how to get you started. So talk to us, and we'll get you started in the journey. Yeah.
There's always the starting, but then there's the staying. And that's brings us back to the earlier mention of discipline. How do you help your clients maintain discipline? Because there are scary moments in investments. It's a sure thing, and then something that onto it nobody could have figured out happens, and suddenly you feel and think your portfolio may be endangered. How do you help your clients?
So maybe I can start, and I'm sure Paul will have more to add. But I think from the CIO office perspective, there are two important points here. I think number one is always making investment decisions in the context of that long-term portfolio. Because, and the reason I emphasize that is, when things get scary, there's a temptation to say, I want to sell, I want to go back to the perceived safety of cash. But the thing with the long-term foundation portfolio is you don't give yourself that option. You're basically saying, well, I might change my mix a little bit, maybe I'll reduce my equities and buy, safer, less volatile bonds. But in the bigger picture, make sure that while you make those adjustments, you're always stay invested. And often that's why my favorite way of thinking about investing is not only about getting invested, but it's equally about staying invested. And the long-term portfolio always helps force that. I think the second one is also just about informing yourself. So when we have big events, we've had obviously a US presidential election, we've had geopolitical conflicts in the last year. We always try to put out a little bit more detail for our clients to say, look, let's understand what's going on here. And I think conflicts are a great example of where you see the screaming headlines and there's a big temptation to do something. But the context we try to provide is saying, look, what can we learn from history? Conflicts have happened throughout history, but financial markets have a much narrower view of the world. They don't always care or respond to all sort of, big political events around the world. So just building that understanding, learning from history is the other hand-holding part we do with our clients, so that, when they do think about making decisions on their portfolio, we try to make sure they're as well equipped with the context, the history, and just a little bit more information on why markets are doing what they do and whether there really is a need to do anything.
So let's go about, there is the starting, there is the staying, but let's talk about the 5 principles, right? And I'll just go through them. Discipline, diversification, time in the market. How do I know when is the right time to invest? I will talk about diversification. I'm used to savings. Maybe there are bonds I could get into. There are money markets I could get into, but it is information I am not privy to. Where do I go to? Standard Chartered Bank. How do we have this discussion. But most importantly, in terms of risk, return, and protection, there are risks, there are returns. There is, importantly, how do I protect my investment such that I may continue growing this wealth? Because at the end of the day, all we're doing is making sure that this wealth does grow. So in terms of from the bank's perspective, how do we have all these principles understood by the client?
Yeah. So the good thing is that the way we have set up ourselves as a bank, and we have the conversation with the client actually end up executing on each of these principles without consciously knowing they're actually doing it, right? Yeah. So let's start from setting the goal, and once we set the goal, immediately what we are doing is we are creating that long-term view. That's number one. So the timing question start getting included as part of the philosophy, the investment philosophy. We're saying it's 10 years. So something may happen in the short term. It's like a bump in a journey or a pothole in a journey. It doesn't stop you from going the journey, right? So time in the market or start getting in. Then the second thing that we have is around the discipline. So we have set up some of our investment that takes a regular deduction every month. So we call it the wealth builder or regular savings plan. So again, it gives you that disciplined way of putting money aside every month. And once you set up the plan, I mean, you go away and the bank does the rest. So again, you can see the discipline question coming in. And of course, bringing the RM and the investment advisors in there to keep helping you stay on the guardrail, right? Diversification, I think we can overemphasize that. Our CIO, or in terms of how they give us the information, the advisor is very well rounded in terms of where do you go to equity, in what measures, where do you go in bonds, in what measures, how much do you need to retain in cash, how much of gold, as Manpreet has detailed. And of course, protection. I think that's the subject that we don't discuss a lot. And really, when you think about the client goals, the one thing that can upset those long-term goals is a risk event happening on the client's own circumstance, like a life situation, like, a healthcare emergency, right? Or a demise within the family, something the breadwinner, not being there. That can really upset a lot of things. That's why we bring the insurance aspect. We partner a lot with Prudential, Sanlam, to look at how can we create a protection of the breadwinner, so that in case something happen, doesn't upset the overall long-term plan of the children getting to college, right? So these things we actually embed them, and we have created a very interesting way. I mean, our RMs have done a lot of good job, like where they look at coupons coming from the bond portfolio and putting those as premiums for insurance policy, for life insurance policy. So it becomes a really neat thing that the client doesn't have to cough any additional money from their pocket. This thing is like a seal, right? Yeah. So it's kind of very interesting, some of the ingenuity that we are finding coming out. And some of these are ideas clients are creating. Some of them are ideas that we are creating. But that we are trying to play it again and again across the
Paul, can you expound on that just a little bit? That little creative thing that you talked about. So you said you used words that I need to be able to connect. You said bonds and then being able to attach it so that what could happen. Just go.
So a bond gives two payments, which we call a coupon, in a year. Okay, so if you have a January and a July, a February and August, like that. So every year a bond pays twice.
So there's some money that's coming to you twice a year.
Yeah, exactly, to your account. That's the whole promise of a bond investment, right? And then on the other side, an insurance policy requires you to pay. You can set that to be twice a year.
Yes.
As well.
Right.
So if your coupon comes in January, say of 50,000, then you have a policy of 50,000 or 45,000. It's really nice.
It does it. So you don't have to look for extra money to sort that out.
So you got an investment and you got protection.
That's fantastic.
Yeah.
You mentioned insurance and you mentioned the word life. Investment, the volatility of markets sometimes, yes, can be a threat to life. However, what protection is given in a situation where it is not so much that you have gone on to the next world, but your means of earning has been challenged and you no longer have it. Is there protection for that?
Yes, there are. So all our life insurance policies come with critical illness, permanent disability cover, and embedded. and they are free riders. You don't have to pay extra to get that. It comes as part of it. And when we have conversation with the insurance companies, we negotiate for that, because we ourselves, we are looking at it from a wealth management tool. So we actually recognize, yes, you may be incapacitated, and as such, then you need the policy to pay off for your medical expenditure at that time, or you have a critical illness. And secondly, after that, the policy, the premiums that need to be paid for that policy to last the whole term are taken over, so you don't have to keep paying again. Yeah. So we put that as part of our policies.
And if your job comes to an end, are there insurance policies that look into that as well?
Okay, I'll take that as well. So we launched, during COVID, we launched a retrenchment cover because we saw the risk of people losing jobs. Unfortunately, it didn't do very well.
It couldn't have. I mean, COVID was unprecedented.
Yeah, it was unprecedented. So we've really been looking at the data around that and just seeing in what way and form we can, bring a product that take care of the client's inability to make payments. However, when we come to the loan side, where we have given a credit to a client, we recognize that if they get on the basis of their pay, we recognize that if the pay the job is not there, then the ability to pay the loan also is not there. So we have a protection against that.
Okay.
Yeah.
So, I mean, Manpreet, when we talk about wealth, I think we've come to the place, and this has been great, because like I said, over the last 6 or so weeks, we've been at least getting a little bit more and more conversant, and being comfortable to actually say the word wealth. But unfortunately, we're still in a place whereby somebody talks about wealth and you think, oh my goodness, if I'm going to be talking about wealth, then it means that I must have a mansion sitting in a corner of some leafy suburb. I must drive a 2.0 luxury vehicle. I must be able to, vacation somewhere in some sandy beach. For a lot of us, that is what, wealth means. But I'm hearing us now talk about wealth that when you have put away something, or when you've invested, and then you're able to then grow something that will allow you to depend on it in the future, does that also equate to wealth?
Absolutely, it does. And I think what's important, I think there were some great examples you gave, right? Wealth means different things to different people. And wealth could be a mansion, but wealth can also be the ability to comfortably fund your kids' education, 20 years in the future.
Right.
So I think it comes back to the point about saying, defining that goal up front, and also saying, look, just the ability to sort of put some capital aside and sort of see it grow and help, tangibly achieve those future goals for yourself and your family and for people around you. That can be a great sort of example of, having wealth. And I think that's where, it comes to the factors, it brings to a lot of things we discussed today, whether it's about, thinking long term, whether it's about having the discipline around it, whether it's protecting, that wealth. But I think really sitting down with a financial advisor and saying, look, this reaches to different sort of parts of the wealth space, different parts of what a bank can do, but it's really about sort of stepping back and saying, what do I really want to achieve?
Right.
What's important to me and my family? And then, how can the whole wealth process really help achieve that? It's not just the cars or the mansions. It can mean many, many different things which don't fit the common definition of wealth.
Absolutely. So you can create it, which we've spoken about. You can manage it, we've spoken about. You can grow it, we've spoken about. But one thing that we haven't talked about as much is protecting it. I mean, what am I going to do? I've put it in a fund. What am I going to do to protect it? I don't know. If the whole market crashes tomorrow, there's nothing that I can do. So when we talk about protection of wealth, how is the person whose money is being kept aside, or I come in my RM and I say, well, let's see how are we protecting, and what policies are put in place, or what practices are put in place to ensure that what you have created, grown, managed can now be protected.
Yeah. So I'll take that and Manpreet can add. So the aspect of protection get embedded into the way we actually get into the business of managing your wealth, and diversification is one. So you actually start looking at how do you protect your wealth against a specific or a market event. Say, for example, what you said, a crash in the stock market, right? So interestingly, and history has it, like the moments when they've had like a market crash, it is out of that a significant amount of wealth is made.
Right.
I mean, look at 2008, 2009, the financial crisis. Look at COVID. It was a period when while there was a crash, there was the rebound was amazing. So the ability to diversify the portfolio, and also the ability to keep you calm and help you ride that wave to come out to the other side is one of the areas. Of course, from the life perspective of the investor, the insurance comes there. And also we look at also the property side, because remember, part of the wealth our clients have is in the property, the houses they have, the cars they drive, and the content that they have in their homes, right? We also have insurance for that, so that of course, if your house burns down or something really happened, floods, in Kenya that has been there, that's a significant part of your wealth. If it's swept away, then really takes you quite far back. The ability to have an insurance policy against it, and again, we create that ability within our overall platform, is amazing. It's a way of protecting wealth, and we can go on and go on. The last bit I want to speak about is protecting your wealth as it moves to the next generation. Do you know one of the biggest areas where wealth gets destroyed is at the transfer stage? You've done a fantastic job to create the wealth, grow it and all that, but can it see light in the next generation? So our ability to put the right structures to house that wealth so that it outlives you is also a way of protecting
Talk
your wealth.
about these structures, please.
Okay. So, and I know in the past we've been here with a lawyer to go through the legal structures of how to contain wealth. But essentially what we are looking is, do you have a will? The wealth that you have require maybe a trust? Okay. Do you have businesses? Is your wealth in businesses, and maybe what you require is a holding company? Okay, so that it puts the various businesses into place as a holding company, and the shareholding thereof, so that the wealth can be able to transfer to the next generation. We also think about where, in terms of geography, do you actually hold the wealth? So as a bank, we have started a couple of years back. We started the international banking, meaning you can bank part of your wealth. You can bank it in Jersey, in UAE, in Singapore, in Hong Kong, India, China, right, and of course in Kenya. Creates diversity. So again, you're looking at geolocations and saying, wow, maybe the level of my wealth has reached such a level where I actually need to be banked in multiple jurisdictions.
Right.
Again, how do you approach that? So we can be able to help you as well.
I think at the center of this entire conversation would be how we communicate to the clients to understand all this, because I want to get to a bank that understands me. I want to be a client to someone who would sit me down and guide me through which is the best way to invest, which is in terms of diversification, which alternatives do I have. And for a very long time, it has been seen as though it is all about bring your money, we bounce, But here is a question where you're sitting with an individual who's taking you through the processes, through the policies that are there, in terms of let's make wealth for today, tomorrow, and even forever, So in terms of just addressing these, what makes you stand out?
Yeah. So maybe Manpreet, you can start
sure.
off. Yeah.
I could start on that one. I think you use three really good words, right? And I think it's about being present throughout the entire journey. So a lot of what we discuss about discipline, about long-term portfolios, I think it really comes to that today, tomorrow, and forever, being present all the way. And I think the second part is really about acknowledging the fact that many of these decisions can be emotionally quite significant. And the way we address them is to really put more of a framework that helps establish a bit of discipline around it, saying, look, it is sometimes scary when markets are volatile. It is sometimes scary when you think about, the big questions about intergenerational wealth transfer. But I think a lot of the two sort of topics I discussed earlier, one is about just, educating oneself. It helps reduce the stress and the worry. I still remember very early in my career, someone showed me a chart of, the big sort of financial crisis through history, right? And a long-term investor sort of said, 30, 40-year returns. They said, look at how much stock markets have made you. And I remember asking them, but what about 2008 crisis? What about 1999 dot-com blow-up? And they said, look, on that long-term perspective, can you even see it on the chart? On a 30-year horizon, it frankly didn't matter. If you just went away on vacation for 6 months, your portfolio did fine. But it comes to the point about, being aware and putting sort of events when you're in the middle of it, it doesn't feel like that.
Yeah.
So being able to add that context and saying, okay, in my framework, which helps establish discipline so that I don't respond entirely with emotion, what's the decision? Is the decision that maybe I should do something about it? Maybe the decision is, I don't need to do anything about it. What does it mean for my today portfolio? What does it mean for my tomorrow portfolio? What does it mean for my forever portfolio? Is this impact my ability to fund, kids' education in 10 years' time? Actually, a lot of short-term volatility may not impact that at all.
Yeah.
Volatility of markets and economies is a big thing, especially when it comes to whatever you're going to put aside, invest. So how does that come into play? I mean, I want to look at the African continent as a point of reference. Every time we have an election, for example, outgoing administration, incoming administration, there's volatility, and people are saying, okay, if we're going to put some money here, do we wait until we have a new administration? Do we wait until this one goes out? So this is actually a question that's coming in from some of us this morning, and it's, how does then market or economic volatility, political volatility affect the investments that one would put in? And is this a conversation that you continually have with your RM, wake up in the middle of the night, hey, the vote is coming in, what are we going to do about this money? Are we going to move it, kind of thing? How does that work out?
Yeah, I think what we've actually realized is that, of course, economies grow through cycles, and that becomes one of the things that our CI office really look keenly to see at what stage the various economies that we are tracking, at what stage are they? Are they expanding? Are they, coming off? And interest rates has to do a lot in terms of how the central banks manage, that into the economy. But interestingly, on the political side, we find that the political events are very short-lived.
Yes.
They don't play into the market a lot, interestingly. And there's, I know there's quite a bit of research that the CI office has done around that. They actually don't play short-term, yes, and they feel like, oh my God, right? But really, the markets quickly forget those political events and keep moving on, because markets are generally driven by the overall fundamentals in the economy as opposed to specific political events.
Right.
Yeah.
And I think that's a great example of how history can really add a bit of perspective. So, two examples, right? I mean, US elections, that's a big political event. We're in the midst of that transition. But if you look back over the past century or so of data, actually, once you go beyond the 2-3 months around the election, it's pretty hard to discern the impact of the election on financial markets. They move on pretty quickly. It's fundamentals that matter. A second example that's one of my favorites is South Korean equity markets, because that's a market which, unfortunately, over the past 3 decades has had to deal with almost an unending series of fairly significant geopolitical events. But what you see in equity market data is, other than creating maybe a month or two of volatility, markets have again quickly moved on. Now, every now and then you do get the more significant one, but I think it's really about acknowledging markets do have a much narrower view of the world than what matters to us at a broader level, and learning from history. I think those two factors are what we try to add from the CIO office, just to make sure, whether it's the end investor, whether it's the RM, that we're equipped with the perspective. So we're not making a decision just on short-term emotion, but we're disciplined, aimed at the long term.
Indeed. So Paul, getting into 2025, we're still early in the game. Just a reminder in terms of a couple of things that we should remember or think about coming to Standard Chartered, talking to an RM, or just saying, hey guys, here I am and I want to be able to do something. Which way are we going?
Yeah, so again, visitors, any of our branches, we have RMs in all our branches, and they're equipped to handle this conversation to get you started. Or you can email us at wealth.kenya@se.com, and we'll be able to pick it up from there. Yeah, absolutely.
What if I don't have an account with you right now, and how do I get
easy? Same way, just visit us or email us, and we'll get you started. The good thing is we get to open your account digitally as well, so a very easy process, and to get you set up for investment. Again, technology comes very handy. Yeah, absolutely.
Okay, and just one final one, because where it just seems as though folks may feel as though I may be financially illiterate, and I say that I do not know where to go, I do not know what to do, and I don't want to present my ignorance. But then, in terms of how comfortable folks would feel to be able to be sure that with whatever situation that you are in, somebody can help.
Absolutely. I think, as we say, we communicate in public, but we advise in private. And that's our role, that's our fiduciary duty. We treat every conversation with a client in confidence. So, and we really encourage our clients to come and tell us exactly what they are going through in terms of financial, what their goals are, so that then we can be able to have a very robust conversation and plan for them. It's like a doctor conversation on a patient, right?
Yes.
You're going to have to tell the doctor how you feel.
Tell everything that's going on.
Yeah. So then they can help to make you feel better. So we believe we are the financial doctors. Come talk to us. regardless of what it is and where you are, really, that's where we start. And in fact, that's our job. That's how we are trained to do. We are trained to help our clients become better from a financial perspective.
Absolutely. And it's great to have had both of you here this morning. I mean, just getting into 2025, what you can actually do and the options that are available for you. Manpreet Gill is the Chief Investment Officer, Africa, Middle East and Europe, Standard Chartered, and Paul Njoki is the Head of Affluent Banking and Wealth Management Products, Kenya and East Africa. Thank you both for being here this morning, getting us into 2025 proper and the things that we can do and how you can create, grow, manage and protect your wealth getting into the future. Thank you both for being here.
This is the Situation Room, the only way to start your day.